Financial. Here, we put companies on the anvil and we hammer out the truth. Today, that company is Booz Allen Hamilton. Now, their latest earnings report, it sent the market running for the hills. All you saw were headlines screaming about a revenue drop. And that's the kind of noise that creates panic. The kind of panic that makes people sell perfectly good companies for terrible reasons. So we are here to ask the hard questions. Is this the first real crack in the armor? A sign of some fundamental weakness that's about to shatter the whole structure? Or is the market just panicking over a surface-level dent in a foundation that's actually made of solid steel? We're here to cut through all that noise, hammer on the facts, and help you forge a stronger portfolio. Let's get to work. Okay, let's not bury the lead here. This right here, this is the number that has everyone spooked. And you know what? For good reason. A 10.2% drop in revenue? Come on, that's not a rounding error. That is a massive, double-digit decline. When you see a number like this from a major government contractor, a company that's supposed to be the absolute definition of stable, your first thought isn't about opportunity, it's about finding the lifeboats. Is the ship taking on water here? I mean, this looks like a major fissure in the hull. You can't just brush this off or try to explain it away with a bunch of corporate jargon. This is the kind of headline number that signals a real fundamental breakdown in the business, a failure to execute. So I have to ask, how is this not the first most obvious sign of a total collapse? I hear you. I do. And that's exactly the gut reaction the market is having right now. That negative 10.2%, it is a scary number. There is no doubt about it. It's the kind of figure that flashes bright red on a trading screen and just triggers the algorithms to sell, sell, sell. It's so easy to look at that, panic, and just join the herd running for the exit. But here at Iron Financial, we don't run from the scary numbers. We put them on the anvil. We have to hammer on the details to see what's really going on underneath that big, scary headline. Is the foundation actually breaking, or is it just being tested by a storm? Before we declare this company broken, we need to understand why that number is what it is. It's time to deconstruct this thing. All right, let's dive right into this. Section 1, deconstructing the revenue drop. This is where the entire bear case lives and breathes. That top-line number is the whole basis for the market's fear, so we are going to put it under a microscope. We're going to break down exactly what management said caused this decline, and then figure out if their reasoning actually holds up under pressure, or if it's just a weak excuse to cover their tracks. Let's see what the company's own filings have to tell us.
And here we go. The usual suspects. Of course. Management is pointing the finger at a prolonged government shutdown and a slower funding environment. I mean, it's the classic corporate playbook, right? When the numbers look bad, you blame the weather, you blame the economy, you blame the government, you blame anything and everything but your own execution. So the real question on this slide is pretty simple. Are these legitimate reasons for a 10% revenue crater, or are they just, convenient excuses, a smokescreen to hide some deeper operational problems? Because let's be real, every single company in this sector faces the exact same political environment. The strong ones, they navigate it. This looks less like navigation and more like getting blown completely off course.
That's a fair challenge, a totally fair challenge. And if they were just throwing out these vague excuses, I'd be right there with you, hammer in hand. But what's really interesting here is that they didn't just blame the shutdown. They quantified it. They actually put a number on it. Look at the data. This is directly from their guidance crosswalk. They're telling us very clearly that the prolonged government shutdown, which, by the way, lasted half a month longer than they had initially planned for, accounted for a 0.15% negative impact. And the slower funding environment, which delayed the ramp up on new contracts, cost them another 0.35%. You combine those, that's 0.5% of impact. It's a real headwind, for sure, and they've put a precise number on it. This proves they have a really precise handle on their operating environment. This isn't spin, it's accounting. But if these headwinds only account for 0.5%, it begs the question, where in the world did the other 9.5% of the drop come from? To find that answer, we've got to look deeper. Okay, so we've acknowledged the top-line damage and the external factors. The revenue story is, well, it's ugly on the surface. But if that's all you look at, you are missing the most important part of this entire report. And that brings us to Section 2, the profitability paradox. This is where the bull case really starts to take shape, where it's forged in the heat of operational discipline. Because while the market is completely fixated on the shrinking revenue, something totally contradictory was happening deeper inside the company's engine room, something that challenges the entire narrative of a company in decline. Now just look at this. This slide lays out the paradox in black and white. It's so clear. On the left, you've got the top-line trauma we've been talking about. Revenue down 10.2%. That's the number causing all the fear and panic. But on the right, you have the profit engine, adjusted diluted earnings per share, or ADDPS. That's the actual profit delivered to shareholders after you strip out some of the accounting noise. And it's not down, it's up. It's up a massive 14.2%. So the crucial question is, how on earth can a company be shrinking on the top line while simultaneously becoming significantly more profitable for its owners on the bottom line? This is the central question we have to answer right now. And this just illustrates the point beautifully. This isn't some accounting gimmick. We're looking at real year-over-year growth in the one metric that matters most to investors, earnings per share. In the same quarter last year, they delivered $1.55 per share. This quarter, despite all those revenue headwinds, they delivered $1.77. That is a solid, undeniable 14.2% increase. While everyone was watching the front door shrink, the company was busy fortifying the factory floor and making it radically more efficient. This is the engine room of the company, and it's running stronger than ever. Whoa, hold on a second. A 14% pop in earnings while revenue is falling? That smells like financial engineering to me. Are they just cutting costs to the bone, firing engineers, and mortgaging the future just to make one quarter look good? And what is this realization of significant tax benefit stuff? That sounds like a one-time sugar high that's going to lead to a crash later on. You can't just create profit out of thin air. How is any of this sustainable?
That's exactly the right question to ask, and it's where we separate the amateurs from the pros. But the data here gives us a very clear answer. This isn't just one thing, it's a combination of solid operational discipline. First, strong contract execution. That means they're delivering on their projects more profitably than they expected. Second, yes, effective cost management, but not cutting to the bone. They're just running a leaner, more efficient ship. Third, the tax benefits. They're specifically from R&D credits, which is just smart financial management that rewards them for innovation, something you absolutely want them to be doing. But crucially, look at that last point. Their adjusted EBITDA margins are holding firm at 10.9%. That tells you the core profitability of their operations is rock solid. See, margin is the truth serum of a business. If the margin is stable, the business is healthy. This isn't financial engineering, it's a testament to their operational strength.
So, the income statement tells a complicated story. A weak top line, sure, but a powerful bottom line. But a company's true strength, its real ability to withstand storms, isn't just found in its quarterly profits. It's forged in the balance sheet. So let's move to Section 3 and ask the big question. Is Booz Allen's foundation actually made of steel? We need to look at the long-term structure. We're talking about debt, cash flow, and leverage. This is where we find out if the company is built to last or if it's all just a house of cards. A foundation of steel? Are you kidding me? Look at this number. Nearly $4 billion in total debt. That's not a foundation. That is an anchor dragging this whole company to the bottom. In a rising interest rate environment with a slowing government funding pipeline, a debt load this massive is a ticking time bomb. Every basis point the Fed hikes just tightens the screws on them. This is a huge structural weakness. How can a company with shrinking revenue possibly support this kind of liability? This looks less like steel and a lot more like a pillar of salt, just ready to dissolve in the first rainstorm. This could be the crack that brings the whole thing crashing down. I see your $4 billion anchor, and I raise you an $801 million engine. This number right here is net cash from operating activities just over the last 9 months. See, debt is only a problem if you can't pay for it. And Booz Allen is a cash-generating machine. Just think about it. They generated over $800 million in cash simply from running their business in only 3 quarters. That isn't just enough to service their debt. It's enough to invest in the future, return capital to shareholders, and weather any storm that comes their way. The debt is the weight they carry, sure, but this cash flow is the muscle that carries it. And that muscle is incredibly strong and, crucially, predictable, all thanks to their long-term government contracts. And this is the final nail in the coffin for the debt argument. This is the net leverage ratio. It takes the company's net debt and compares it to its earnings. A ratio of 2.5 times is not just manageable. For a stable, cash-rich company like this, it's perfectly healthy. It proves the foundation is stable. The debt isn't a threat. It's a tool they are using effectively to finance growth. The market sees the big scary debt number in isolation and it panics. We see it in the context of massive cash flow and a healthy leverage ratio. The foundation is absolutely made of steel. All right, so we've established that the company is profitable and the foundation is absolutely solid. But, a strong foundation is totally useless if you're not building anything on top of it. And that brings us to our next section, and maybe the most important one, forging the future. We need to see the blueprint. What is management actually doing to get that revenue line growing again?
What strategic moves are they making to ensure they're not just surviving, but that they're positioned to thrive in the years to come? And here's a major piece of that blueprint. Booz Allen announced a strategic partnership with Andreessen Horowitz, probably better known as A16Z. Now, for anyone who doesn't know, A16Z is one of the premier venture capital firms in Silicon Valley, period. They are on the absolute cutting edge of technology. We're talking AI, cybersecurity, biotech, advanced computing, the whole shebang. This isn't just some minor investment. This is a clear, forward-looking move to plug one of the oldest government contractors directly into the heart of future technology innovation. They are positioning themselves to bring Silicon Valley's best and brightest ideas to their government clients, making sure they're ready for the next generation of government work, not just the current.
A groundbreaking partnership. Right. It sounds great in a press release, I'll give him that, but what does it actually mean? Is this a tangible plan that's going to generate real revenue and real returns for shareholders? Or is this just a headline-grabbing PR stunt to distract everybody from that ugly 10% revenue decline? It's so easy to put out a quote about investing for the future. Are they just getting a newsletter from these guys, or is there a real strategy here? I need to see proof that management actually believes their own story. Where's the evidence that they actually see clear skies ahead?
The proof? The proof is right here, in their own forecast. Let's go right back to that guidance slide. After reporting this tough quarter, what did management do? Did they lower expectations? Did they signal weakness was coming? No, they raised their guidance for adjusted earnings per share for the full year. They took their range from about $5.50 and moved it up to around $6. A company that is worried about the future, a company that thinks its strategy is just PR fluff, does not raise its profit forecast. This is management telling the market in the clearest possible terms that they are confident in their strategy and in their ability to execute it profitably. They are putting their money where their mouth is. Okay, we've hammered on the revenue, we've examined the profit engine, we've tested the foundation, and we've looked at the blueprint for the future. We've seen the arguments from both sides, the fear and the facts. Now it's time to put all of these pieces together and step back from the anvil. It's time for Section 5, the iron financial verdict. Let's lay out the bull and the bear case side by side and deliver our final actionable conclusion based on all the evidence we've just gone through.
Look, the bear case is simple and it's powerful. It's driven by fear, sure, but it's based on a real number. You have an alarming 10.2% drop in revenue that you absolutely cannot ignore. The macro headwinds that caused it, the slow government funding, the political gridlock, they aren't just going to disappear overnight. And you've got this massive, nearly $4 billion debt load in a really uncertain interest rate environment. And this future strategy, this A16Z partnership, it's still completely unproven. This is a picture of a company facing some very serious external pressures with a lot of weight on its back.
But the bull case is equally compelling, and it's rooted in pure operational strength. While revenue fell, profitability soared, with adjusted EPS up over 14%. That was driven by strong cost and margin control, which proves this is a well-managed company. The so-called massive debt is easily supported by a river of powerful operating cash flow, which results in a very manageable 2.5x net leverage ratio. The foundation is solid, they are executing with precision, and they are making smart, forward-looking investments in their own future.
So, here it is, the iron financial verdict. The bear case, which is the market's current view, is completely fixated on the dents in the armor. And look, those dents are real. The revenue drop caused by the macro environment is ugly, but it's surface-level damage. When you hammer on the underlying structure, you find something else entirely. The profitability, the cash flow, the balance sheet, it's all forged from a foundation of steel. This company is built to withstand exactly this kind of storm. The market is mistaking the noise of temporary damage for the signal of a terminal decline. This is a classic case of short-term fear overlooking long-term strength.
And that leaves us with the final question, the one that you need to answer for your own portfolio. Is the market right to panic? Or is it making a classic mistake, mistaking the noise of a temporary storm for the signal of a permanent crack in the foundation? We've laid out the facts, we've tested the metal, the decision, as always, is yours. Thanks for joining us at Iron Financial. We'll see you next time.